In this chapter 6 in the text, I'll be going through some of the PowerPoint slides that are listed in Cengage now. I wanted to mention that there are a few of the slides, especially as they relate to itemized deductions and 2% of AGI, that are no longer valid. So I was looking for the authors and the publishers to update, but I went to the website in Cengage and they still haven't updated. Just some of these slides, most have been updated. Just so you know, for 2018 through 2025, the 2% of itemized deductions, miscellaneous itemized deductions, is now gone. And so that does not apply. So any reference to those in the PowerPoint slides is not up to date. However, the text is up to date. So I recommend deferring to the text on those issues. In this video, I'll be, as I mentioned, discussing just some of the more salient and important aspects of Chapter 6. I encourage you to read through the rest of the PowerPoints as well as the chapter. And I'll be going through some demonstration problems regarding rental income and split purpose rental properties and personal use properties. All right, so before we get to that, let's take a look then at certain deductions we know are deductible for AGI. Those are far more beneficial because they reduce the adjusted gross income, which of course impacts deductibility of itemized deductions as well as certain credits. So we know that deductions for AGI are more valuable. So here's a comparison of deductions for AGI and from AGI. Again, if it's for AGI, it actually determines adjusted gross income. Where if it's from AGI, then AGI has already been determined, and these deductions, like on Schedule A, are less significant or less beneficial on a per dollar basis because they don't reduce that threshold that impacts subsequent deductions. So for AGI, we have a $15,000 reduction that reduces our AGI to $30,000, and then we deduct the from AGI deductions of $12,000 in this case, and we have taxable income of $18,000. You can see the difference when we can take a deduction for AGI and from AGI. So we'll be talking about some types of Schedule E and Schedule C deductions that are for AGI. So here are some of the deductions for AGI that are not. Some are related to business and some are not. Alimony, at least for 2018, is still deductible by the payer. That will be phasing out. And so deductions from rental and royalty property. Deductions for AGI is partial list here. Some are related to business, some are not. Some of them we're familiar with, but we're going to be learning more about rental and royalty property in this brief video and in this chapter, as well as some others we've talked about, such as student loan interest. Contributions to IRAs, for example, traditional IRAs are deductible subject to limitations, especially if the taxpayer has a employer-sponsored pension. There are certain limitations there for traditional IRAs. Moving expenses only applies now to military personnel. That can be deducted for AGI, and up to $250 of teaching costs that the teacher incurred on behalf of their students for elementary and secondary education. Just to name a few. Itemized deductions, so these are from AGI. These are after AGI has been determined. Medical expenses, again, we want to update this a little bit. It's still in excess of 7.5% at the moment. It is not 10%. It is 7.5%. Personal casualty losses is subject to 10% of AGI and $100 floor per casualty reduction. We know about charitable contributions. That has increased to 60% in many types of contributions. Certain state and local income taxes, again, there are some new limitations. Up to $10,000 now of certain state and local income taxes can be deducted as an itemized deduction. I want to highlight a little bit, half the self-employment taxes paid is deductible for AGI. Reasonable and necessary salaries paid for services, and expenses for the use of business property are deductible as well, as long as they're ordinary, normal, reasonable, customary. Section 212 expenses, these are deducted for AGI, that is to say they determine AGI. I mentioned on Schedule E we'll be discussing rents and royalty income, and so if there are some reductions in income, deductions, for example, for a rental property, those can be reduced, netted against passive income, and that of course would reduce the adjusted gross income. Sole proprietorships, these pass-throughs, rents and royalties, Schedule E, farming operations, Schedule F. Refund of taxes, excuse me, would be reported as income in the event that the taxpayer itemized in the previous tax year. These, I mentioned earlier, the itemized deductions for the miscellaneous itemized deductions have been suspended. So deductible losses, generally it's very straightforward for businesses. Most losses incurred by businesses are deductible against the income of that business. However, personal expenses and losses are either not deductible or have significant limitations on them. And then, of course, this is new this year. In 2018, an individual for a small business is allowed a 20% deduction of qualified business income from operating a sole proprietorship, partnership, or S corporation. The 20% rule is designed to allow small businesses to enjoy a reduction in taxable income, much like C corporations have received a significant reduction in the corporate tax rate from 35% down to 21%. Well, this provision of 20% of qualified business income is designed to give these smaller businesses, these pass-throughs, the same kind of, or a similar kind of tax benefit that the corporations enjoy. There are limitations on the deductibility of qualified business income, and in general, these from AGI deductions for QBI is the lesser of, and then they have the qualified business income or the modified taxable income, which is defined as taxable income before qualified business income deduction reduced by a net cap gain reported, or the qualified business income, which did not include wages, cap gains or losses, dividend income, and interest income. So you compare these, and then you take the lesser of the two to reduce the from AGI deduction. Please keep in mind that this qualified business deduction of 20% is not for AGI, but from AGI. So it is not used in determining AGI. Other limitations on the qualified business income deduction, again, it's a rather complex provision of the tax code. It's brand new, but it does have further limitations. If the taxable income of the QBI is more than $315,000 for married filing joint, or $157,500 for everybody else, then you look to another set of reductions and qualifications, and the QBI deduction cannot exceed, once these income thresholds are met, it cannot exceed 50% of the W-2 wages relating to the qualified trade or business, or the sum of 25% of W-2 wages related to that business, and 2.5% of unadjusted immediately after acquisition of all qualified property. That is, the unadjusted basis. So you can take 2.5% of unadjusted basis, add that to 25% of W-2 wages relating to qualified trade or business, and then compare that to 50% of the W-2 wages and take the greater of the two. Limitation of the 20% reduction is phased out over time once the married couple has reached income thresholds of $415,000, $207,500 for everybody else. So again, we look to these two-tier limitations is first we're looking at those, and I'll just use a married filing joint for the moment. If the income is less than $315,000, then you're going to look to these limitations, as I discussed earlier, to determine whether or not the taxpayers can take the full 20% reduction of business income. If, however, the income of the married taxpayers who filing joint is greater than $315,000, now you look to these limitations to determine the deduction, if any, of qualified business income. What are the qualified trader business? These are specified trader businesses: health, law, accounting, actuarial science, performing arts, consulting, athletics, brokerage services, financial services. So these are deductions for qualified business income. Specified business services such as attorneys and accountants, we'll discuss in Chapter 9. There are some certain rules that apply to the way we can recognize income and expenses relating to those specified service businesses. The reporting procedures on Form 1040, we'll be hitting several of these, not so much on farm income for Schedule F, but we'll be discussing Schedule E for rents and royalties, Schedule D for cap gains and losses, Schedule C we're talking about today as well, and then interest and dividends we've talked about in the past for Schedule B. So these are all deductions for AGI, and we mentioned that earlier on 1040. And these are the supporting schedules and forms that support these deductions for AGI. I mentioned earlier that these deductions from AGI appear on Schedule A, and they include charitable contributions, which has increased this year to 60%, medical expenses at 7.5% of AGI, casualty losses for individuals is a reduction of $100 plus 10% of AGI floor. Miscellaneous itemized deductions, I said, are now gone. They've been suspended from 2018 to 2025. So these particular PowerPoints are up to date. This particular PowerPoint is up to date on that issue. And then total itemized deductions is netted out of adjusted gross income. Unless the standard deduction is greater, then you would take the standard deduction and deduct it from the AGI to determine the taxable income. And then, of course, be sure to deduct the brand new deduction for qualified business income, which is up to 20% of qualified business income for those who operate businesses. In terms of method of accounting, generally most taxpayers, individuals, are on the cash basis. So we recognize expenses and income when they are either incurred or paid. On the accrual side, expenses are deductible when incurred. And of course, we apply the all events test, all the events that created the liability, and that's been economic performance as well. These two tests must be met in order to accrue. There's also a 12-month rule for both cash and accrual taxpayers that applies for prepaid expenses. Excuse me. Deductions are disallowed for certain types of expenditures that are illegal, such as penalties, fines, illegal bribes or kickbacks. Not that some penalties are not necessarily illegal, but they're penalties incurred, and many of which are not deductible. Generally, if they're contrary to the public good or public policy, then fines, penalties, kickbacks, bribes, 2/3 of treble damage payments for violation of antitrust laws. All of these kinds of expenses that are incurred are not deductible. However, interestingly, if a person is on the receiving end of a kickback or a bribe or a fine, then they are required to report that as income. But if you're paying these items, then they are not deductible because they're contrary to the public policy or public good. Talked a little bit about those. If there is excessive executive compensation, so for example, if we have covered employees such as a CEO and CFO, generally the limit on that income for deductibility is $1 million. And it also now includes commissions and performance-based compensation. In the past, we excluded those elements from the executive compensation. So the IRS believes that in many cases, income of greater than $1 million annually is excessive. They do grandfather in contracts that are pre-2018, as long as there are no material changes to the contract. So that they're in place at November 2nd, 2017, they'll be grandfathered in. Otherwise, the compensation above $1 million is considered excessive. Any investigation, if a taxpayer is in a business and they're investigating another or similar business, these investigation expenses are deductible in the year paid or incurred. I have some problems set aside that I want to discuss for rental and vacation homes. So sometimes folks will have a second home, maybe a cabin at the beach, at the lake, and they may use it themselves and they may rent it out. And the question is, those expenses that relate to that home have to be apportioned or allocated between personal use purposes, which are often not deductible, and rental income, which can be deductible. So the rules to determine whether or not the income is treated as a vacation rental income or as personal use income are really important. And so I'll run through an example of that in a brief video. So rental vacation, I'll run through an example of how to calculate rental vacation homes. And finally, personal expenditures pursuant to the tax code are not deductible. In the next video, I'll be going through a demonstration of how to apportion rental income when the property is used for dual purposes, that is, rental and personal use. I'll also be going through a brief explanation of the hobby loss and gain rules.